Welcome to Techtastic, where we navigate the intersection of technology and business, uncovering innovations that redefine our world.
Ryan Rosett, it's so lovely to have you here. Welcome to It's Techtastic.
Great. Thanks, Christian. I appreciate it. And I'm looking forward to having a conversation with you.
So Ryan, you're the founder and CEO of Credibly, which is a funding mechanism for early stage startups. Can you tell me a little bit more about how it works? I mean, I've got a technology startup myself. I have lots of friends in that space, and we have a lot of guests on the show. So there's probably a huge interest in what you're doing.
Yep, absolutely. So just to clarify, so we're a financial technology small business lender. So it's, post revenue, just to be clear. So, some people will come to us pre-money and or pre-revenue, and that's not what we do. 6 months in business is the minimum threshold for us. So it's, small businesses can certainly, or new businesses can certainly come to us seeking working capital. We're effectively a cash flow lender. We look at a bunch of different data sources and data points to really develop a risk model associated with the customer and define what they can afford based on the industry type and how much we can provide them in working capital without impinging on their cash flow.
It's often difficult to establish credit as an early company, even if you've got cash flow. 6 months old is not old in banking terms, right? You're a newbie.
Yep.
So what are some of the things that you're looking for to help reduce the risk of lending to these early stage or smaller companies?
So, it really depends on the industry type. So we have a ton of data. We've funded, in excess of $2.5 billion, I think, close to 50,000 small businesses. So we have a very vast amount of data that we look at when we make a decision for a small business. Our models are about 60% plus comprised of cash flow. So we're really studying the bank statements. And then there's also, personal credit. Business credit isn't really play a huge role. We use some business scoring mechanisms that are available out there, but it's a much smaller piece of our model. So, we do look at personal credit and attributes and some, structured data that goes into our models. We look at inquiries, and there's a whole bunch of different things that's weighted. Time in business is important, obviously. And like I said, it's all risk-based pricing. So a younger business, it will be more expensive capital because the charge-offs will be higher for those. A more established business, a doctor, with 15 years in business and perfect credit, we're going to give them much better pricing.
You said that the funds come actually fairly quickly once it's approval. There's a lot of automation clearly involved in that. But are you working directly with banks, or are you a private lender that's acting on your own?
So we're acting on our own. We're an on-balance sheet lender. We do borrow money from banks.
Okay.
So, just to be clear, that's how we have our funding sources. We just completed our third asset-backed securitization. So we have a large credit facility with a regional bank. We fill that up, and then it's a revolving asset-backed securitization. So we take the assets from the credit facility and then dump it into the ABS. And that is because it's constantly turning and changing. So as assets come out of the asset-backed securitization, we're putting new assets into the securitization.
Anytime that somebody's doing something interesting with the financial space is good, I think, for the general economy, because liquidity and the ability to move money around is so important. And early companies have a lot of struggles around that because, frankly, you just haven't been around long enough for anybody to care.
Yeah, I'd say, Christian, that also when you look at banks today, the macroeconomic environment for small businesses, they're just not lending to these types of credits. And, that's where our business model sort of fits in. Our average loan size hovers around $70,000, which for a bank is a super small loan. For us, it's our average. And so that's, that's where we fit in. We go up to 600,000, but, it just kind of evens out at approximately 70,000 for our average loan size.
Do you have inbound interest, or are you actually out prospecting and looking for customers?
We have a ton of inbound. So we do all the sort of usual marketing strategies, SEO, SEM, PPC, along with many other channels. And then we also have what we call a wholesale channel, which is through a broker network that are just business loan brokers. And, I sort of compare them to a mortgage banker, that are working with individual small businesses to procure capital for them.
So now I want to hear the origin story. You're the founder and the CEO, and there was some moment in time where you said, I've got it. This is what I'm going to build. And my assumption is that it evolved over time to a degree too. But what was that moment?
Okay, so it goes back to 2009. I was a partner in a bridge lender backed by secured by real estate. And if you go back to 2009, 2007 to 2009, we were in this Great Recession. And in that period, there were tons and tons of commercial real estate being taken back by banks. And so we were providing bridge loans to the developers or owners of the property and to buy these assets back at a discount from the banks. And this business sort of came to me as like a different business, certainly a smaller credit, contrarian time, and just decided, and really had no experience in small business lending, and just decided to start the business. And so I do have a partner. His name's Eden King, and he had really good experience on the underwriting side. He was in the wholesale mortgage business before, and so it was a good match because I sort of am more on the revenue and sales side, and he's more on the underwriting and ops side, and so the two of us complemented each other's skills.
And neither one of you is a technologist. Because what often happens, I find, in technology startups is that the technologists tend to get excited by the technology. Something new came into the world, blockchain, AI, whatever it was. What can I do with this new exciting toy? And what I find with a lot of successful founders is that if they're the technologists, they found that other person that's a lot more like, hold on, the problem is this. The opportunity is therefore this. Now, how do we use technology to enable that versus the exuberant, I'm going to go do it individual. But what gets all the hype in the market tends to be the ones that have said, what can I do with this amazing new technology? But we don't know if there's anything there. And so I like stories like yours because it's how businesses are actually built. It's not the hype. It's not the technology coming around and enabling something new. There's an opportunity and there's a market for it.
That's exactly right. The opportunity was that small businesses had zero access to credit at that time. And then we had the wind in our back all the way through the pandemic. But then if you think about what happened during the pandemic, there was plenty of sleepless nights because, we had a very large portfolio of small businesses where like every business, 2/3 of our portfolio called in seeking relief, and this is like pre-PPP. And, this is like when it evolved and they did a lockdown. So you can imagine the stress that was happening. And then when government money flowed into small businesses' bank accounts, it became sort of like a boon for businesses like us because the losses were so low because there was so much government money in the system. So, and now we're back to, what I'll call pre-pandemic levels where we're seeing the same, sort of losses. But, I would argue today, small businesses are in a recession.
Right.
While the general economy may not be, we're seeing stress. And we graduated to a more higher credit quality during sort of this period of time. And we maintained our loss rates, throughout the period.
Downturns in the economy that I think that we're looking at the edge of right now. We're looking right at it. If you're in the tech sector, if you're a technologist, you've seen the layoffs, you've seen the companies that are letting go of big portions of their staff, and it definitely feels like to me 2006, 2007 when we were looking at it, or 1999 through 2000 before the dot-com bubble burst.
Yeah,
it looks very, very similar. You're seeing a lot of the same types of activity. There's certain roles that tend to get hired for more in that time. The go-to-market technology sales-based roles, you see a lot more business development opportunity, which is usually bad. If you're doing a lot of hiring in that means you're not hitting numbers.
Yep.
So it's an interesting moment. And this is a time when good businesses actually do exceptionally well because your competition goes away because they're not run well. They don't have a good foundation from which they sit. You said that during COVID, you saw tons of small businesses close. You then saw the PPP relief come in and everybody was able to stabilize. But post that, you saw a lot of closures again, almost immediately afterwards, right? Because they couldn't get the labor, they still couldn't get the things that they needed. People were still nervous about going out at the same levels, maybe. And I'm not entirely sure all the drivers there, but there was still hesitancy to be out and doing things. And now we're kind of in that exuberance after the fact. Everybody's out. Like I live on a place that's a vacation location, and this summer's nuts already. It just started and it's been absolutely crazy. that's great for the small businesses, assuming they solved all the other problems. But if they're carrying a lot of debt, they're in trouble, right? That's what I was seeing with a lot of restaurants around town and things like that, is they did get through it barely, and they took on a lot of debt to do it, and now they're just trying to figure out how to stay alive. And these wonderful, exuberant times of the moment aren't enough.
Yep, I agree. And I would also just add that, I don't think, the small businesses adjusted to the inflation the same way other businesses have. So, while they may have raised their prices by 50 cents or whatever the case may be, it doesn't match what they're buying the goods for. And then how that flows through to labor costs and everything else that's sort of like set in on the inflation front.
Yeah, they don't feel like they've got any firepower to do it either. That's the real problem for them, is even if they did try to adjust their prices to deal with the inflationary problems that they've got, they know that they're competing then with, if they're retail, they've always been competing with Amazon, but they lost their only advantage there.
Correct.
And right, if you're a restaurant, people are only willing to pay so much to go out, often enough to keep you alive. So it is an interesting time. But the strong survive. The ones that had a good foundation are going to do well.
Yep. And that's what we, we've been investing heavily in, our tech, for the past 5 years, since we really started, we've been investing heavily, but I'd say we really poured the gasoline on, 5 years ago in really data science, technology. And, in the last year, like everybody is like sort of, looking at the generative AI space. So, and we have a few provisional patents pending. We have some interesting use cases that we think will really kind of allow our business to leverage, sort of the large language models, and in a way that is going to be, it's going to help us with risk. It will help us with reporting. And, I would say like another feature that we're really sort of focused on, it just provides it's like a superhuman, or it's a human assistant that we're able to leverage in the right cases, because there's the difference between lending to a consumer and a small business is that the small business is shielded by an entity. And so you have to sort of like get behind that entity and see what is behind the curtains. You don't necessarily always know, but that is like a very important part of like our underwriting process.
Yeah, that ability to do the superhuman level of research and understand all the details involved in it, and to come up with, I imagine your patents are around coming up with a score of some variety for them, and what the risk profile of them looks like.
Yeah, the patent that we have that's pending really looks at the industry codes, which is like a very important part of like developing what is the affordability for the business. So while that may sound like a very like unsexy use of Gen AI, when you look at like the Nexus codes, there's like 1,000+ industry classifications. We use codes to segment industries that is different than a government database, and it gets granular, and we use the LLMs to sort of identify what the business is. And, because sometimes, for example, it's it will be XYZ plumber. Okay. And are they a plumber, or are they a plumber supplier? Do they manufacture plumbing good? Like, so it's not, the names don't always provide enough detail as to what industry they actually are.
Yeah, those industry codes are a very interesting signal, because you can, by sector, you can see how they're doing. You can see what for example, if you're investing in them, what's the typical multiplier on revenue, or how are they valued, right?
In margins, I always, like a simple example is like a restaurant's going to have a higher margin than a grocery store. A grocery store, the revenue might be outsized, but the margins at a grocery store are going to be tiny comparatively to like other businesses. So like so it's really important to get the industry type right, so that you can make better risk decisions, and you can make sort of more attractive offers to businesses that you want to lend into.
Now, is it your plan to is Credibly always going to be the first party lender, or do you guys have plans to start going broader with that?
So we've had multiple conversations. Like banking as a service is like, it's had like a lot of ups and downs. So like, we haven't seen many businesses really sort of take off. If you look at the models, the banks will never get comfortable with our model or our underwrite. Even though we have all the data to support what it looks like, banks are still going to ultimately say, hey, we have to use our models, which is fine. But it's like their models might reject everything that comes in our door. Like, that's the beauty of what we do, is like we're less focused on the credit of a customer, more focused on the cash flow. And we think that is the evolution of lending, is, really looking at cash flow versus like, this person has a 750 FICO, and we should give them money, or the profit, for example. I don't care if they're profitable.
VeriSign has the same view, where they're looking at people that don't have credit scores because they just never took on debt, or they never had payments, or lived with their parents, but they have tons of income, right? Why wouldn't you lend to that person? Well, because they don't have a credit score, but they have revenue equivalent. Right?
That's exactly right. So like, we're just, like, if you can get the industry right and you can get the affordability of what they can afford to pay based on the industry, then you're, I think we can predict the risk or the probability of default fairly well.
Yeah, totally makes sense. It's surprising, I think, to people outside the financial industry that credit works the way that it does. They're like, but I make so much money. It's like, yeah, but you've never taken debt. And the way that your score is entirely based is the available credit versus debt. So you're better to take out more loans but don't spend it. Like, just keep it there and take out more credit cards and don't use them, or use them just enough so that they continue to do that.
Yep.
Because the incentives are wrong, right? The incentive is really set up to trap you in a debt cycle. Whereas with what you're providing, you're trying to help the business do their job better. You're giving them cash when they need it so that they can continue to generate more cash flow and grow.
Yes, exactly right. I mean, so, obviously, like, what we want to do is be a responsible lender, provide them working capital that we believe they can afford to, first and foremost, pay us back. But if they use the money wisely, they should be able to succeed. So if they use the money, if it's a restaurant, to put a patio and get more seating so they can get more revenue, that's a great use of capital. If they're using it for taxes, that's a fine use of capital too. So it's there's a number of ways, and some people, to be honest, it's not that we ask for the how they're using their capital. Once we put the money in their bank account, we don't have a tracker of how that dollar is spent, so you just don't know what they're going to do with it. We've had people, after they've borrowed money from us, have said, I had my daughter's wedding, and they're using their business as a little bit of a piggy bank. And, it's not like it's not exactly the desired use that I would want, but like, on the same token, they have a viable business that can support the cash flow, and they pay us back, and they were able to use the proceeds of the funds to do what they needed to do.
Yeah, the only reason I wince is like, there's liability associated with that, and I hope that they understand what they're doing.
Yes, well, I'm not condoning it, but it's So I'm just saying that people and some people are brutally honest too. Some people will tell you exactly what they're doing with the funds. So.
Well, Ryan, we're getting short on time, and I just want to make sure that you've got time. Is there something you wanted to share with the audience that we haven't talked about already?
Yeah, I would just say that we continue to innovate at Credibly. It's an interesting time from a macroeconomic standpoint, but we continue to improve our process, our user experience. We just launched what's called an online checkout, which basically, once you're approved, we send you a link, and in 10 minutes of going through the process, the money gets put into your bank account. So, which is a very cool technology where, we're using biometrics, and, it's obviously geotagging to where the customer's business is, and then it's pulling cash flow from the bank accounts, and but in a really seamless, elegant user experience that we think is, sort of best in class, that will allow us to continue to grow, and in the world of frictionless customer experience, that we're moving in that direction as well.
And that's a wrap for this episode of Techtastic. I want to thank you personally for joining us, and we'll see you next time. Until then, keep exploring and stay curious. Thank you for listening. If you are new here and enjoyed the content, please subscribe. It really helps us out. And if you are a regular listener, thanks so much for your continued support.
Overwhelmed by tech debt? Discover Vala AI, the solution to tech challenges with the simplicity of a click. No engineering background? No problem. Vala AI enables anyone to effortlessly tackle tech issues, freeing up your time from tech headaches. Make tech debt vanish with Vala AI, where your tech solutions are just a click away.